This video will help you understand the capital gains tax impact on the sale of your primary residence. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. It appears as if people in the United States will move about 11 times during their lifetime, and I imagine at least one of those transactions or one of those moves will be due to the sale of a primary residence. Odds are a few primary residence sales. Generally, that means selling the real estate for a gain, which results in capital gains, which results in capital gains taxes. Specifically, the IRS allows some relief as it pertains to the taxes on capital gains for the sale of a primary residence. So in today's video, we'll help you approximate what the net taxes will be due to capital gains on the sale of your primary residence. So let's jump in. Now, while the math is somewhat similar for selling investment property and rental property compared to a primary residence, there's enough nuances that those types of transactions will require its own video. So in today's video, we're only focused on primary residence sales. Technically, your primary residence is just anywhere that you are currently living and is your home of domicile or home of record. As it pertains to how the IRS would define your primary residence as it pertains to receiving some tax exclusions, aka paying less in tax, they'll define it using an ownership and usage definition. And the ownership and usage definition is for the past 5 years of you owning the property. Did you use that property for 2 of those past 5 years? If you own the property for 2 years and you lived in the property for 2 years, that's your primary residence for the purposes of benefiting from a tax exclusion we'll talk about in a second. And for those of you who are thinking about converting your primary residence into a rental property, but are concerned about losing out on the Section 121 tax exclusion, which we'll touch on in a second, rest assured I'll touch on that at the end of the video, so you can either watch through or jump below to the timestamp where I talk about how you can still benefit from the exclusion even if you flip your property into a rental property. For everyone else, let's walk through a quick example of what a real estate transaction could look like and then help you understand the taxes associated. So let's say I buy a piece of property for $500,000 back in 2010. That's considered my basis. That's what I paid for the property. And that basis really doesn't change. When I go to sell that piece of property, if I sell it for more than $500,000, well then I am generating what's called a capital gain, and normally I'll owe capital gains taxes on that gain. Now, without getting too nuanced in the differences between ordinary income tax rates and long-term capital gains tax rates, simply put, you'd much rather prefer to pay long-term capital gains rates because those are going to be taxed somewhere in the ballpark of 0 to 20%, and pretty much everybody will pay 15%. Contrarily, on ordinary income taxes, so the taxes associated with salaries, bonuses, interest income, that could range from 0 to 37%. And this is not factoring in any sort of state-specific capital gains or income tax, nor is it factoring in a potential 3.8 net investment income tax. We'll have to touch on those in a future video, but to keep it very simple, pretty much in every circumstance I can think of, you'd much rather have $1 of long-term capital gains and then pay those taxes than $1 of ordinary income and pay the relative taxes. So back to the example. In 2010, I buy a $500,000 piece of property. That's my basis. When I go to sell the property today in 2024, let's say I'm looking to sell the property for $1.5 million. Well, how much I sell the property for minus what I paid for it is my capital gain. So in this example, there'd be a $1 million realized capital gain. Now, for the sake of simplicity, I'm using long-term capital gains as that definition. Technically, you could generate what's called short-term capital gains if you buy the property and then you sell the property in less than 12 months. That would generate a short-term capital gain. Those capital gains are taxed at the ordinary income rates we talked about before, and most people don't do this with their property. So for the sake of simplicity, we'll just assume you held the property for at least a year. Now, $1 million of capital gains taxed at a 15% long-term capital gains rate is $150,000 in taxes. Rest assured, you don't actually owe this much in taxes if this transaction happens under your balance sheet. And that's because the IRS affords people who have a primary residence, as defined earlier, of owning and using that property for 2 years of the past 5 years. You're allowed to exclude quite a bit from that capital gain. For single filers, you're allowed to exclude from your capital gain $250,000. And for those of you who are married filing jointly, you're allowed to exclude $500,000 of capital gains on the sale of your primary residence. This is called the Section 121 exclusion. You're allowed to exclude a portion of your capital gains. Now, for a lot of real estate transactions out there, if you don't exceed those thresholds, either $250,000 for single filers or $500,000 for married filing jointly, well then you would owe nothing in capital gains taxes on the sale of your primary residence. Theoretically, that means that if you continue to meet the IRS's definition of a primary residence, you could keep benefiting from the Section 121 tax exclusion for the rest of your life. barring any changes in the tax law. However, if going back to the previous example where you're recognizing a $1 million capital gain on the sale of your primary residence, this tax exclusion wouldn't be enough to cover all those capital gains. For the single filer, they might recognize a $1 million capital gain and then exclude $250,000 and therefore only have $750,000 of long-term capital gains that they'll have to pay long-term capital gains taxes on. And at a 15% rate, that'd be around $112,000 in taxes. For the married filing jointly couple that recognized a $1 million capital gain and then excluded $500,000, they pay capital gains taxes on $500,000 of long-term capital gains. At a 15% tax rate, that'll equal $75,000 in capital gains taxes that will be due next April. So the moral of the story is, get married before you sell your property. Or at least be mindful of the tax benefits of being married in this type of transaction. There's probably other more important reasons that you may or may not want to tie the knot. Now, there are some things you could do to shrink the effective capital gains on both sides of this equation. The first and most common one is adjusting your basis. So back in 2010, when I bought this property for $500,000, for example, my basis was $500,000, and unless I do any changes to the property, my basis will stay $500,000. Now, you might have heard of people using depreciation relative to the sale of real estate. That doesn't apply to primary residences. However, the IRS says if I make any major improvements to my property, whether that's, installing an HVAC system, building a new deck, or, remodeling the kitchen, etc., those are all improvements to the property, and that increases my basis. And now I go from having just a regular basis to what's called an adjusted basis. And by definition, the higher my basis, the smaller the impact of capital gains. Now, general repairs and fixes will not go to increase your basis, so you can't fix a leaky faucet and then increase your basis by however much you hired the plumber for. And you can't clean the house and then consider that to be an expense and increase your basis. Those are all considered things that are generally part of routine maintenance on a piece of property. Now, unfortunately, if you don't keep any records of these major improvements, you will probably be SOL as it pertains to increasing your basis at the time of sale. And if you don't remember what you originally paid for the house, aka what your original basis was, rest assured, usually the county assessors and things like that keep track of this information, and you can always do some digging and find it there. Now, there are some other things you could do to reduce the impact of capital gains, and that's where you actually can take away from the total sale price any expenses you incurred to sell the property. For example, these are called selling expenses, and I'll link down below to the IRS's form so you can see more literature on exactly what they're talking about. But things like if you have legal fees, advertising fees, realtor commissions, things like that, even if you recognize a $1 million capital gain, but you paid $50,000 in selling expenses, then you'd actually only be able to recognize $950,000 of capital gains. Contrarily, there are actually some things you could do that might increase the impact of capital gains that you weren't aware of. For example, even if you list the property for sale for $1.5 million and you're thinking, okay, I'm going to recognize a $1 million capital gain, any additional financial benefits that the buyer provides to you as the seller would count against you by way of that capital gain, meaning any financial benefit that they give you would increase the capital gain you're recognizing. So for example, if let's say they choose to cover some of your property taxes, or they choose to buy your mortgage out from you, those are all financial benefits that you'll have to factor into the sale price, and that create more of an adjusted sale price, which thus means you owe more in capital gains. Quick note on assuming a mortgage from somebody else, that's generally where the buyer chooses to take over the existing mortgage of the seller, which really wasn't too common over the past decade, but would actually be super beneficial in today's environment where odds are the boomers that bought the property that they're selling today for retirement have a 3% mortgage, if any mortgage at all, and you as the new buyer would have to have a mortgage at like 6% or whatever the floating rate is today. So buying out a mortgage at 3% could make a lot of financial sense versus starting a brand new mortgage at 6%. But if you're the seller in this example, that would be a financial benefit you'd have to factor into the total sale price, thus resulting in higher capital gains. For my more savvy real estate transactors, you might be thinking, okay, well, what about deferring the capital gains? Meaning don't pay taxes today, but use all the proceeds I get from the sale to go buy another piece of property. Technically, that's called a 1031 exchange. And we're not going to get into the nuances in today's video, but just know that this does not apply to the sale of primary residences. You can only do that with investment property. back in the day, you could basically 1031 exchange the sale of a primary residence capital gain into another piece of property as long as you use all the proceeds towards another property, but you can't do that anymore for the sale of a primary residence. Now, for those of you in Washington State who might be familiar with the Washington State capital gains tax, that tax is applicable to those who generate more than $250,000 of capital gains in a tax year. However, that tax does not apply to real estate transactions. And I'll link above to my previous explainer video on that if you're curious to know how this might play a role for other transactions. Lastly, for those of you who are thinking about converting your primary residence into a rental property, but you're concerned that the property has appreciated a ton, if you then go sell the property 5-6 years later, you won't benefit from the Section 121 exclusions we've talked about. Well, that's a very justified concern, and there are some ways to play within the joints. So going back to the IRS's definition of over the past 5 years, have you at least owned and lived in the property for 2 of those years? As long as you meet that definition, you should be in the clear. Practically what that would look like, I actually have a client who's doing this. They're planning on retiring to Spain in the next year, and they have a piece of property here in the greater Seattle area that's appreciated quite a bit. So this capital gain tax exclusion would be very, very beneficial. However, they're not sure if they want to sell the property and just be done with it, or if they want to turn it into a rental property to help supplement retirement income. We're going through the pros and cons, but one strategy we came up with was if they choose to keep the house as a primary residence and then choose to rent it out over the next couple years, they have 3 years to be a landlord on the property they own before, after said time, if they sell the property, they would not benefit from the exclusion. So if they choose to sell the property after having it being rented for less than 3 years, well, then they still met the IRS's 2 of the past 5 years ownership and use definition, and they'd still benefit from the Section 121 exclusion. They don't have to own and use the property for the last 2 years of the past 5 years, just for 2 of the past 5 years. Unfortunately, if they move out of the property, rent it for 3 years, and then continue to rent it, the only way they'd benefit from that Section 121 exclusion would be to move back into the property, live in it, and use it for 2 of the past 5 years. Then they could sell it and benefit from the exclusion. So a little bit of nuance there to be aware of. If you're planning on doing a transaction like this, I'd highly recommend seeking a tax professional to provide some guidance. So from a calls to action standpoint, if you need the sale of your primary residence to sail you past the retirement Rubicon, you absolutely will want to know how capital gains taxes can play a role. This is also important because even if you have a bunch of money land in your bank account, you should definitely factor in the tax impact, because next April, you don't want to get caught blindsided if you already made provisions for those real estate proceeds. From a behavioral standpoint, it could be very easy just to stroke a check to the IRS for the amount of approximate taxes. You can do that online, or I guess physically you could mail in a check, but I normally don't recommend that. Or you can just wait until next April when you get a 1099-S in the mail, which says, here's how much you made on the sale of this piece of property. And then you rack and stack that against your basis, and you produce the transaction on your tax return and submit the appropriate taxes. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.